Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Friday, December 5th. We have a jam-packed show for you to end the week. We have some major news, of course, that Netflix is the winning bidder for the Warner Brothers Discovery acquisition, announcing it will acquire the studio and streaming operations for more than $80 billion in cash and stock. Does that deal make sense? Will it go through? We have got our co-executive editor, Martin Pierce, coming on in just a moment to break it all down. We'll then turn to some exclusive reporting on why Silicon Valley is buzzing about Apple's succession plans, even though CEO Tim Cook has made no public indication he's stepping down. We also have a standout weekend read, a deep profile of the Broadcom CEO Hock Tan, and why Broadcom might be NVIDIA's most credible challenger. After that, we'll get into this week's Editor's Cut, diving into the intensifying rivalry between OpenAI and Google. And to close out the show, I've got a great conversation with the CEO of Dude Perfect, one of the biggest names in YouTube. It's going to be a busy show, and so let's get right on into things. Netflix has agreed to acquire Warner Brothers Discovery studio and streaming businesses for $82.7 billion. It puts an end to a bidding war that also included Paramount, Skydance, and Comcast. It is a big deal, and I want to bring on someone who I know has thoughts on all of this. Martin Pierce is the co-executive editor at The Information. Martin, what do you think?
I think this is the stupidest deal. And I have to say that in the history of dumb media deals, it's very hard to sort of, pass them. AT&T's purchase of Time Warner in 2018 at the time appeared to be the world's dumbest deal. They ended up, of course, spinning that off. This is even stupider. In fact, this is such a stupid deal. I'm even beginning to wonder whether Netflix knows this deal will not get through, but they are just trying to screw up Paramount and delay Paramount's ability to actually buy Warner.
Okay, so I want to unpack all of those things and all those thoughts. Let's go to what they're actually agreeing to buy. What part of the business is this?
They're only buying the film studio, Warner Brothers. It's an iconic film studio, and they're buying the HBO Max streaming service. Those are the dual assets, but they're not buying the parts of the business that actually make the most money, which are the cable channels, which are declining. So that makes sense. Thank God for that. But the price they're paying is absolutely enormous. And the problem is, this is not going to add to anything. Almost everybody who can have Netflix has it already. Who is pay for Netflix now that you can get, HBO Max on it? They actually admitted this morning there's an awful lot of overlap between the two subscriber groups. So this doesn't give Netflix anything except debt and the need to spend the next 18 months negotiating with the government to try to get this deal approved. And I think in the end, it will get opposed, and the thing will just, collapse. So I think it's a gigantic mistake.
So you don't think the deal will go through at all?
No. I don't think there's any chance that the government is going to allow the largest streaming service to buy one of the other very big streaming services, particularly as Paramount, which was competing to buy Warner, is close to the administration and will obviously do a very, intense job in arguing why this deal should be opposed.
So on the call this morning, what is the putting aside the idea that maybe Netflix did this as a way to sort of stop the other companies from getting their hands on this property? What is the strategic rationale then that the executives are saying? And look, you look at the stock this morning. It's not like the stock has fallen off a cliff this morning for Netflix.
The stock had already fallen 15% in the last 6 weeks or so. So I think this is already expected. The strategic rationale that they gave was not really there. They said this would give consumers more choice, which makes no sense because consumers can already get all of this content. They just have to pay for both services. So putting How does that give them more choice? They said that this would create jobs, which is really a fascinating argument, given that they've already said they're going to cut costs, so this will actually destroy jobs. They really didn't say anything that actually made any logical sense. So that's why I'm beginning to think maybe this entire thing is just a fake effort to sort of delay Paramount. I mean, I do think that there's a defensive element to it. They wanted to prevent anyone else getting their hands on these assets, because that might have affected them, because it might have, made somebody who's competing with them even more effective. But really, they're also just paying such a high price that I don't think it's worth it.
Right. So let's talk about, why was Warner Brothers Discovery, why was it going up for sale in the first place? Talk us a little bit through the history here.
It's a long history. Time Warner was sold in 2018 to AT&T because the management at that time decided that they could see the writing on the wall. The company was predominantly the cable channel business, which is in decline. So they decided they would just exit. AT&T bought it. AT&T was obviously a disastrous buyer. They don't understand the entertainment industry. So after a few years, they decided to sell it. Discovery bought it. They understand the entertainment industry, but in buying it, they took on debt, a huge amount of debt, and they've had to spend the past 3 years cutting costs to try to make the deal work. And I think, and so far the stock has done really badly. So I think that people saw the opportunity to sort of move in. And this was sparked by Paramount, which is the Ellison family's company. They are trying to expand, and they made an offer which led the company to put led the board to put the company on the market. But it seems that the board didn't want to sell to Paramount. I'm not sure why, but in any case, this is where we are now.
Right. And so now, thinking about this, in the scenario here where you're saying the deal doesn't go through, I guess I'm trying to keep it open to a possibility that maybe it goes through, right? And then Netflix has to take on all this debt to fund this acquisition. Debt, of course, just like you pointed out, debt is the thing that dragged down a number of the media companies in the first place. I mean, 3-4 years from now, what happens? I mean, to the business that it's acquired.
Well, I think if the deal does go through, Netflix will then spend several years cutting. I think that they will raise prices. It will, I just think that we'll end up maybe in the same place that we are in now. They'll probably end up, I mean, I'm not sure. It's really hard to tell, but
Right.
I don't think this will be good for them in the end.
Great. Well, Martin, I want to thank you for coming on. And I know you just published a piece on this as well, which I encourage everyone to read. We will link it in the show notes. That is Martin Peers, the co-executive editor here at The Information. Okay, Apple's succession plan has gotten a lot of buzz lately, and even though Tim Cook hasn't said anything about leaving, a lot of people in the Apple orbit have a short list of people that they think could take the reins next. My colleague Aaron Tilley published a deep dive on the topic with a ton of inside reporting, and I want to bring him on to talk all about it. Aaron, welcome to the show. It's great to have you here.
Yeah, thanks for having me.
So why is everyone talking about Apple succession these days?
There's a lot going on. There's been, over the past year, an acceleration of just turnover at the direct report ranks to the CEO, Tim Cook. And then on top of that, this is now 15 years into Tim Cook, nearly 15 years into Tim Cook's reign, and he's just turned 65. There's a lot kind of coming down the pike in terms of with AI and questions about, is Tim Cook kind of hustling enough and getting Apple prepared for that stage of technology. So, there's a lot going on with changes with executives and the overall tech industry.
And the week of news that we had this week, I mean, we saw a lot of departures. We had retirements too. John Ganandria stepping away from the company. We had the I think it was the general counsel that is also moving away. And then I think the third was it was an executive moving to Meta. Are these sort of a reflection of that, or is this just a long time coming, really?
I mean, this is a long time coming, but definitely a reflection, I think, of setting up the succession plan, because you're getting the sort of stable group of executives who are going to be with the next CEO. You don't want when the next CEO is appointed for a spat of executive departures right then. These executives are also preparing to retire, and so do it ahead of time before the new CEO comes on board.
Okay, so now you dived. I don't know what the past tense is. You went into a couple of the candidates. John Ternus was the candidate that you said has been talked about the most. Who is John Ternus, and why are people talking about him?
Yeah, he's a really, he's kind of in the mold of Tim Cook. I mean, he comes from a different group, coming up in a different group, not operations like Tim Cook, but hardware engineering. And he is young relatively with the rest of the senior vice presidents at the company. He's 50. That sets him up to be the youngest senior vice president at Apple, reporting to Tim Cook. And so he comes from this background doing hardware engineering, leading their hardware product group. And that's like, he is in his demeanor very Tim Cook-like, which I think is, it bonds him to Tim a bit on that point. But he also comes up more product oriented than Tim. So I think there's some appeal there that he's going to be a more product driven CEO than what Tim was. I don't think the differences are that big in terms of demeanor and disposition, but I think, potentially more product driven company with him taking over.
And who else is in the running? I mean, Craig Federighi is a name that we know from a lot of their videos and keynotes and stuff like that. He's up there.
Yeah, for sure. He's I think definitely has been considered, but he doesn't have from what executives we've spoken to, that he maybe isn't the right candidate. He's very fixated on software, not on sort of hardware, and not on sort of the policy issues that you really have to dive into as CEO. So I don't think he's a super strong candidate at the company at the moment, and I don't think he really wants it, to be honest. So it's just a name certainly that's been floated about.
And are they convinced that they have to go internally to look for the CEO? Are they looking outside at all?
No, they're pretty fixated on an inside candidate. Apple is a very particular culture, and outsiders really struggle inside there. It's they're kind of pushed out if when you come in from the outside, you just do not mesh well. So it's a task. So I think it really needs to be an internal person.
Right. Well, let me ask you this. I mean, Apple is kind of at this inflection point here with AI, and we've had you on the show before talking about some of the growing pains they've had with their products. Is there an argument to make in saying that the person that you need to pick should be, I guess for lack of a better word, I mean, they should be AI native in some ways, right? They should see the future with AI. They should help the company go in that direction. Do you think that is one lane they might explore, and how do they balance that with obviously the hardware or the supply chain? I mean, these are all sort of non-AI things they have to be versed in.
For sure, I think the next CEO has to have AI as a strategy going forward. But I think this company, its DNA will always be rooted in hardware. I think that is where they excel, and that's where they have to still maintain their excellence. So I don't think they can choose somebody who comes from AI as their leader. I mean, I think they need to take it seriously and build great products around AI. But this company's DNA, I think, will always be rooted in hardware. And I think that's their strength, and why move away from that.
Great. Well, Aaron, I want to thank you for coming on. I suspect this story will get even more dynamic, so I look forward to talking with you more, and we'll see you soon.
Thank you.
Well, NVIDIA may be the undisputed darling of the AI boom, but there is a chip stock that is actually outperforming NVIDIA this year. Broadcom shares are up more than 60% in 2025, roughly double the gain that NVIDIA has had. And it is also emerging as one of the companies that is seen as a credible challenger to NVIDIA's dominance. This weekend's big read is a deep dive not just on Broadcom, the company, but also the man leading the charge, CEO Hock Tan. And I want to bring on my colleague, Jemima McEvoy, to tell us more about the piece that she wrote. Jemima, welcome back to the show. It's great to have you here.
Thank you for having me, as always.
Let's talk about Broadcom. Can you explain what kind of chips exactly does Broadcom make?
Yeah, of course. So basically, what has been the main chip that has been used throughout the AI build-out so far is called a GPU. It's what NVIDIA and AMD make. And it's basically a very flexible chip that you can use for anything, for lots of different types of applications. Broadcom specializes in a custom chip that's known as an ASIC. And the difference is it is cheaper to make, but it is generally only programmed to one application, so it's a lot less flexible. So as the AI infrastructure build out has moved on to kind of its next stage, we're a little bit more certain about what we want to be doing. Custom ASICs have become a much more attractive option just because of their cost efficiency.
So these are chips that they're not as powerful necessarily, but they're customized, and they kind of fall into the camp of chips that it's like, well, we don't need the most powerful thing. We just need something that is specific to our operations.
They actually are very powerful, but it's just geared towards that specific task. So because of how quickly AI changes, it's kind of difficult to commit to, we know we're going to want this task done forever. So that's why it's kind of been a bit of a transition in this later part of the AI build out.
And why are they seen as such a credible threat to NVIDIA?
Yeah, I mean, Broadcom is seen as probably one of the most credible threats to NVIDIA because there's the cost question. The chips are, I think around 30 or 40% cheaper than NVIDIA's. And now, since companies are needing to buy so many chips, they're looking for other options. And Broadcom is the leader in custom silicon. They've been making custom silicon for decades. The company was founded in 1990, and they're known to be really good at it. And the quality of their product is known to be really good. So that's kind of what makes them the biggest challenger.
So let's talk about Hock Tan, the CEO that you profiled. You had a lot of great details about how he's running the company. What stood out to you about his leadership style and the way he's been managing things?
Yeah, I mean, it's no secret that Hock Tan is a very he's a pretty cutthroat leader. He's been known to acquire companies and lay off, half the employees and that's been known, but I really wanted to drill into, who is this guy? How has he built Broadcom into what it is today? And there's, lots of colorful things. I mean, he's extremely cutthroat. He's extremely frugal, no sodas in the cafeteria at Broadcom. There's no business class flights. There's no holiday party. They don't even have espresso machines in there. He ripped them out when he bought VMware, the software company.
So they're just working in like a box, it seems.
And his philosophy is, I'm going to pay you super well, and I'm not going to give you anything else, and you're going to work really hard. And it's interesting because it's kind of different from the whole NVIDIA vision, which is, funding a bunch of moonshots. Jensen Huang is this very philosophical talking about AI. Hock, it's not that he doesn't care about AI, but he doesn't really care about the technology necessarily. He just cares about what he cares about, and what he's good at is making money out of technology. At a conference in September, he was asked about, what he thinks the future of AI is and where it's going, and his response is, "I'm not a cheerleader." So it's really just an interesting case study of this CEO who is managing the company very differently than some of his peers that are leading in it now.
How long has he been CEO for?
He has been CEO for 20 years. He took over the predecessor to Broadcom, which was called Avago in 2005, and then they bought Broadcom in 2015.
But one of the most interesting parts of the story, though, is that you talk about this no-nonsense attitude, and yet people don't seem to be leaving the company.
Yeah, I mean, you would think. I mean, one thing that I describe in the story is they have a quarterly coffee chat, which is basically Broadcom speak for an all hands meeting where Hock, ranks each department based on the amount of money they're making, and then there's this big fat red line, 2/3 or 3/4 of the way down the page, and any department beneath that is considered to be underperforming, and all the employees in that department are like, "Oh my god, I'm going to get fired," because Hock is known for not he'll fire people if they're not performing up to his standards. So yeah, you would think that kind of environment, it's a very stressful and pressure-filled environment, would turn more people away. But in fact, the company has a very low voluntary attrition rate. It's pretty much in line with NVIDIA's. It's under 3%. So yeah, that's pretty interesting. And it's employees describe it to me as they get paid so well they don't want to leave.
Right. And when you talk to people in the company's orbit, he's 74 years old. We just talked about Tim Cook, the CEO of Apple, who's much younger than 74. And already, I think, given the scale that Apple is at, people are thinking about who might succeed him. Has succession come up in the Broadcom story with Hock Tan?
Yeah, succession has definitely come up. I mean, as you mentioned, he's 74. He's older than Jensen Huang and Lisa Su, and he recently, the board of directors of Broadcom recently extended his tenure, his contract by 2 years. So he is officially going to be serving at least until 2030. There's lots of talk behind the scenes about what happens to Broadcom after Hock Tan is no longer the CEO, because he essentially has built this company. It's completely different from when he took it over. It was a $1.6 billion revenue company. Now it's a nearly $2 trillion market cap company. Can Broadcom, continue to grow at the same rate without the leadership of Hock Tan? Some people I spoke with in his orbit think that he will never retire, that he's going to pull it longer and just keep on working forever. But it's hard to say what's going to happen. But it looks like we are beginning to think about succession planning and potentially who will take over, and that will likely be Charlie Kawwas, the leader of the semiconductor division.
Well, so let me ask you this. You didn't have the chance to speak with Hock Tan for the story, although I know you reached out, and it's ultimately the company's decision if they want to put the executive up for an interview or not. But you talked to so many people in his orbit. If you did have an interview with him, what might you want to ask him?
Well, obviously, I think our audience would be super interested to hear some more nitty-gritty on the details of this, the chip fight that's happening right now. Broadcom's biggest competitor in the custom chip space is Marvell.
Right.
It's this competition happening right now where.
What would you want to? What would Jemima be most curious about?
Well, that's where I was getting, is that's what our audience would be most curious about. But for me, I really love learning about the character behind, the company. And Hock is a very private person, hence not wanting to interview. I think, learning about his childhood a little bit more. We know nothing. We don't know what his parents did. We don't know the circumstances of him growing up. I mean, I heard a lot of different tales from people as I spoke to them, but none of them I was able to confirm. So I would love to, kind of hear about his experience growing up and how that impacted, where he's gone to today.
Right. Well, it was a great story, and I encourage everyone to read it. It is our weekend big read this week. Jemima, thank you so much for coming on. That is Jemima McEvoy, our weekend reporter here at The Information. Okay, this week's news cycle has been dominated by the escalating OpenAI-Google rivalry, with Sam Altman declaring a code red as Gemini 3 raises new questions in Silicon Valley about whether ChatGPT's dominance is beginning to slip. We want to discuss all this on this week's Editor's Cut with our editor-in-chief, Jessica Lessin, and managing editor, Laura Mandaro. Here is that conversation. Jessica and Laura, welcome to the show. It's great to have you here.
Thanks, Akash. Hi, Akash.
Laura, if you can believe it, we've done 100 episodes, and this is your first time on the show.
Amazing. Oh, my God.
Well, I'm excited to have both of you here. It was a busy week of news. I want to start by unpacking a little bit the OpenAI code red stuff, which we're still seeing play out in the news cycle. We obviously had some comments from Dario this week as well. And where I want to start the conversation is actually with the investors of OpenAI, because I've been thinking a lot about what they must be thinking with this news. Jessica, I wonder what your thought is here. What are you hearing from that group?
So if you're in OpenAI already, you're a believer. And you're looking at OpenAI and you're saying, fastest growing business in history, this company will get funded, it's all going to be great. I think what I'm hearing over the last couple of days is the people who are on the sidelines saying, uh-oh, which way is this going? We've obviously seen incredible growth. We have seen this company meet the moment, but, they're the ones pointing out the competition. Is the attention too fragmented? What's going on with the compute commit? So it's always been a polarizing company, and I think it's especially a polarizing company right now.
Okay. So Laura, Jessica is talking about the people who are not in OpenAI. There is a group that OpenAI is relying on to keep this funding going for years to come here. I mean, we've talked a lot about their cash flow projections or lack thereof. I mean, does this pose a risk at all for them being able to raise this money, do you think?
I mean, I think that with all the rounds that we reported on over the last couple of years, there's been no shortage of demand. In fact, generally, there's more. The round size goes up. You see it also for the tenders, the secondary sales. And I think, we've reported on these SPVs, which are these vehicles designed to get like retail investors. All I can tell from this reporting is that there's still huge demand from family offices and institutions that didn't get into some of these rounds for like the name brand logo of the AI boom. But, for the very big pension funds that at the end of the day need to see a return and they need to see cash from these investments, they are, watching, I think, everything closely, and they're looking at the, indications from the major companies like NVIDIA and Microsoft about AI demand and if that's going anywhere. And they want to know that this is going to be a real investment. I mean, so far, if you invested a couple of years ago, there's a paper markup, but, you'd have to kind of be living under a rock to not worry that there's a bubble. And if you're coming in at $500 billion, which was the price of the last round, or the tender offer, how much more does that valuation have to go up for you to get even double your investment? So I think there's questions, but it doesn't seem to me that they won't be able to raise.
Right. And there's obviously there's the notion that if there's a company that is able to fundraise at two different valuations at the same time, well, maybe that signals something. Jessica, I'm curious what you made of Dario's comments this week. From our reporting, we've shown empirically that Anthropic is running a tighter ship, but also it feels like on the ground in the way that Dario and Daniela have steered their ambitions, they're a little narrower, a little more focused. Sam Altman, I mean, we had the news this week that, he might even be looking at a rocket company in some cases, right? That was a report that came out. Talk about the contrasting leadership styles here and which one you ultimately think is better for a company like this.
Well, what stood out to me with Dario's DealBook interview was actually, I think, how he's continuing to grow into the CEO role. I mean, Dario he's a wonderfully brilliant guy. And just seeing his public speaking over the last several years, my first takeaway was, he's feeling it, right? He's very comfortable. He, I thought was very compelling in that interview. He seems more confident when you
totally. He was owning the stage in that interview.
And again, if your revenue's grown 10x for 3 years, you should own it and you should take the stage. But I think it's notable because he's not always been the most natural public speaker, the natural in talking. He's always been natural talking about the grand sort of vision, but he felt very comfortable. And I think that is a reflection of the state of the business in the moment, the state of Anthropic's relative focus. And make no mistake, I mean, he left Altman and OpenAI for a reason. I mean, there is a very, very fierce rivalry between those two individuals and those two companies. The reason being, in Dario's estimation, much more of how AI is getting built and the ethics and responsibility around it. But I think we're seeing just the tip of the iceberg, to be honest, of what he really feels about the situation. And, Anthropic has a lot going for it into next year with the business momentum, with the focus. Let's not forget the big picture concerns as well. They need continued business adoption. They need to continue to be able to fundraise from a growing number of partners to fuel this. By not being focused on the consumer market, I think that's a huge advantage for them in many ways. But the big questions that hang over the industry also hang over Anthropic.
Right. Laura, you're going to say something?
Yeah, well, I was just going to say, it's easy to sort of focus on Anthropic and OpenAI. And I want to be clear, OpenAI, as far as I know, did not try to raise at two different valuations, which is a no-no.
Okay.
But the... there's hundreds of other AI startups. And in a way, we've been writing about this almost since the launch of ChatGPT. There's some startups can keep raising at higher and higher valuations, and some almost faster than you'd expect look for an exit. And, we saw these waves of acqui-hire, or reverse acqui-hires, I think, like Inflection. And I think that... fearful sentiment of the kind that's really risen up in the last couple months. It doesn't seem like, a crash reset of the same way that we saw after interest rates spiked a couple years ago. But I do think, if you are a mid-sized startup and, are growing, you may be incentivized to raise one more round of capital now before the gates shut. And we are expecting that things are going to stay busy until it's over. And and even maybe a little bit more. It doesn't seem like some of these startups need that cash right away. They've been so active, but they might, not want to risk it.
Jessica, I want to come back to you because you hosted your predictions webinar this week for our pro subscribers. And, you talked a little bit about the vibe in venture capital land right now. And it's a conversation we had on the show. We were talking about DPI and the idea that, you look at the data from PitchBook, fundraising is still at a 10-year low for these venture capital funds, or at least it's trending towards that if the trend continues. And yet I feel like we don't hear that much about DPI in the conversation anymore the way we did 6 months ago. No. What's the vibe among VCs these days?
Yeah, I'm falling victim to vibe reporting, which is sort of my least favorite thing to do. But yes, I do it. I think there are just real winners emerging. And I'm not talking about the OpenAIs and Anthropics. I'm talking about the Cursors and the Calcies and Polymarkets and all of that, right? And this is not, I think it's a sort of micro adjustment. The big question hanging over is like, how are these funds going to return capital? We've seen more M&A, we've seen a little more IPOs, but we're not seeing, the floodgates really, really open yet. But at the same time, you have funds that now on their books have 10x funds that, we hadn't seen a lot of before. So I think there's optimism a little bit among VCs again. What's happening in crypto is sort of cutting against that and making them a little bit gloomy in the moment. But I'm struck and from sources here things like, I just got this fund's returns and they look pretty good. So haven't heard that in a while.
And so, Laura, if we come to you, I am curious around the reporting questions that you have for your team as you think about this issue. Your team also follows the secondaries market pretty closely. What are the big questions that you're trying to figure out on the ground?
Well, it's not a question as much of a theme. And I think it's interesting, I think when you started your venture fund says a lot about whether these returns are going to look good or not. If you started, right before the pandemic, you're not probably having an IPO in 2021, right? If it's an early to mid-stage fund. So you kind of miss that wave. As Jessica noted, the IPO floodgates have not opened up. So it's hard going. A lot of funds are sitting on SaaS companies that are, they don't, it's not really clear what the exit is. It's not clear if it's going to be PE. PE actually also has a lot of these enterprise software companies that are just not growing that fast. And they are now really at risk of AI. They're not AI companies. So I think I mean, it's not as exciting for journalists because it's a theme that just keeps going on and on. But I think a big question, there is a question over the next couple of years, is what happens to all these startups, right? There's hundreds and hundreds of them that raise a lot of venture capital. They're not, they have revenue. They may even be getting close to cash flow, but they're not growing at the rate and at the size that would make for a public offering. And the buyers are also questionable. I mean, we just broke news on ServiceNow, which is a legacy
Right.
software company, as you know, and they're not. I don't get the sense that they're in the market for a pre-AI enterprise software company to well, then they want the AI companies or the companies that have like a real AI play. So there's a demand for the companies with AI, a real strong AI characteristic or feature. But there's just so many of them, and I think I haven't. There's various ideas, and I just haven't even really discovered what the exit is for so many of them.
Well, and to your point, I mean, the more likely reality is they just go after the talent directly and say, if you're working at one of these pre-AI companies or you're a researcher, I mean, forget the company, we'll just give you a big pay package and come help us. That's probably the more likely outcome here.
Maybe, but I mean, those talent wars are really about AI right now. I mean, and I think a lot of SaaS companies, yes, they have software engineers, but they have a lot of go to market. I mean, I think people are going to be changing jobs just like we saw in every kind of boom bust cycle. It's just, this one's a little bit elongated because these companies they weren't so capital intensive that they can't keep going. They're software companies.
Right.
And so they have a longer ride out, but they're also not growing. And in the past, I would maybe have been a PE play, but I don't think P is in the position to just snap them all up. So
great. Well, I want to thank you both for coming on. It was a busy week, and I'm sure next week will be just as busy. And Laura, I will not let you go another 100 episodes until you join us again. We're going to bring you back on sooner than that. Thank you to you both. Really appreciate it. And we will talk to you both very soon. That was editor-in-chief Jessica Lessin with managing editor Laura Mandaro. Dude Perfect is one of the best-known names on YouTube. Its main channel has 61.8 million subscribers. That is on YouTube alone. And what started as a trick shots channel has turned into a modern media business that last year scored an investment of $100 million from Highmount Capital. And so I want to bring on Dude Perfect CEO Andrew Yaffe to talk about where he is looking to take the company. Andrew, welcome to the show. It's great to have you here.
Thanks so much for having me. Appreciate it.
So I'm excited to talk about all things Dude Perfect, but I do want to get your take. We saw this big deal this morning, Netflix agreeing to buy Warner Brothers Discovery. You're in the land of new media. This is a very old media deal in some ways. Did you have any reactions or thoughts to it?
I was following it along, I think, just as a consumer and an interested observer like so many others. I think my main thought is what it signals about the value of premium high quality IP and how that even as business models change, even as distribution changes, there's real meaningful value in IP that connects with high value audiences. And we're privileged that we think, in a very different way, we play a role in that IP ecosystem. So that's we're excited to see it play out, but mostly interested as an observer.
Right. Well, let's talk about Dude Perfect, the business. I mean, look, people know the YouTube channel. Can you walk us through the different segments and categories of the businesses that you play in?
Absolutely, yeah. So as you said, the guys started a YouTube channel almost accidentally in 2009. They were one of the first big YouTube brands, and slowly built a following over the last now 16 years. And at this point, we've got a really, truly diversified media business. YouTube is still the core of the business, but every summer we do a live tour. So last summer, we were in over 20 cities, had close to 250,000 people come to our live shows, which was just an amazing experience. And we're doing it again next summer. We've got a thriving merchandise and products business, apparel, toys, consumer products, more. And we're launching other media platforms. I mean, our social media, where everyone thinks of us as a YouTube brand, but we've got another 50 plus million followers and subscribers across the rest of the social media ecosystem. We recently launched a podcast that is doing quite well. We're launching more channels over the coming weeks as well. So I think you'll see us be a fully scaled media company in short order.
And if you think about where the revenue is coming from, it is, break that down for us. Is most of the revenue still coming from advertisements and partnerships on the channel itself, or how does that break down?
Yeah, I joined Dude Perfect about 18 months ago, and I came from the National Basketball Association. And so the way I think about the business is more like a sports franchise where we have all the same revenue streams that an NBA team might have.
Right.
So content and our YouTube advertising business is meaningful. Our live tickets is an incredibly meaningful component of our revenue pie, and brand partners. And those brand partners certainly are present in our YouTube, but they're also present in our tour. We've got literally courtside signage at our headquarters.
Yeah.
For our brand partners. I'm here drinking a body armor. I don't know if you can see that.
we saw the bottom half, so we saw the logo at least. The part that matters.
They're our official hydration partner. Just a team or a league would have an official, beverage.
And look, there were reports last year when you guys were doing this big funding round that you were on track to cross $50 million in revenue last year. Did you guys end up reaching that goal? And what are you trending towards this year?
Yeah, we don't get into specifics, but the business is doing very well and we're growing quite rapidly. And are looking to be, well above that now and into the future.
So I want to talk about, some of the considerations you have to make as CEO. I was at the DealBook Summit that had Mr. Beast, the New York Times hosted it earlier this week. They were talking about the economics of a single video that Mr. Beast produces. And he's, of course, known to spend heavily on single episodes, millions and millions of dollars. I wonder, as CEO, you guys put out these videos. Do you do sort of a unit economic analysis on, hey, this video alone needs to be profitable? Is every video itself profitable for you? Or do you think about it more as, sort of a long-term investment? We have this budget. We're going to invest in this many videos over the next 6 months. How do you sort of think about that?
Yeah, I think we're in the fortunate position where we don't need to think of each individual unit as needing to be profitable or to fund itself. It's always nice, but ultimately, we think of the business, and I read a lot about Jimmy's talk in that in many ways, YouTube as the core of our business really is our brand marketing engine. And so investing in videos, investing in great content, connecting with our audience, that serves a purpose of, yes, it generates direct revenue, but probably more importantly, it connects us with audience that's interested in our brand, that wants more content from us. And as we scale the other parts of our business, we can then reach that audience with additional products, additional services, additional opportunities like our live tour, where we don't need to make all of our profits from the video itself. It really enables us to scale the rest of our business.
And I want to ask you a little bit about your product development process as CEO, because this show is largely about tech companies, and a lot of the way that tech companies start is you identify a problem that you want to solve, and you build some sort of a product to solve that problem. The creator economy is kind of interesting because with content, in some ways, it starts out as entertainment, and then you kind of have to figure out what you can extend your brand to and what products would make sense. And so I guess I'm sort of less clear on what that product development process looks like and what research you're doing. And that's certainly top of mind for you. You're looking to expand now into different categories. How do you do that research? What conversations are you having on the ground, and how do you think about new products?
Yeah, it's a great question. I think we do go through a very similar process in a lot of different ways. One is within content, we look at as we're debating new channels or new opportunities, where do we think there's a need? And we talk to our audience. We observe what else is out there, and we try to figure out where's the gap in the system that we think our brand and our ethos can bring something to the table. And the same thing is true in terms of consumer products. We don't want to launch a Me Too, a sort of second product that has already been out there. Everything we do, we try to be innovative and differentiated and really do solve a consumer problem. And we think, as our live tour is an example, people want to find family-friendly, fun experiences, live experiences for their kids. And that's been proven correct. And we think there's a lot more opportunity to do that in a more scalable way. And that's an area that, we look at that as a problem space. And then what are the tools, assets, investments we can make to bring additional products to bear in that problem space. So that's something we're actively going through right now.
And so in that orbit, I think one of the most fascinating decisions that you have to make is, what don't you do? Tell us about some of the ideas that we should expect Dude Perfect to not pursue. I'm talking about the ideas that are in maybe not the recycling bin, but the we're not doing this bin.
There are a lot. When I started 18 months ago, two of the founders came to me with a list of over 100 ideas to consider. What were some of the craziest ones? Some of the ones that we're not pursuing. There's great businesses out there that we just don't think they're a fit for us. In the youth haircut space, as an example, is one that we looked at, but we don't think is a fit for our skill, for our capabilities. We really do think, though, there are a lot of ways that our brand, as family-friendly, sports-focused, competitive, passionate, there are a lot of places to play, and it is not an easy exercise to prioritize which things we do and which things we don't do.
Any other fun ideas that you've discarded entirely?
We like to keep those close to the vest.
You never know. You never know. They could be coming back.
The business landscape changes quickly.
So 3 years from now, where do you hope Dude Perfect is as a business?
I think the number one word we say all the time here is scale. And so I think it is, how do we build? I think we'll have built multiple new business lines that are truly scalable. Look at what Jimmy and the Beast Enterprise has built in terms of chocolate bars, and now he's going into phones and mortgages,
theme parks. Yeah.
I think we're probably not going to end up with a competitive phone business, but I think there are a number of opportunities that we will look to do where it is truly scalable and it is adjacent, but it's a new business line that we have a first party stake in and are not working as a sponsor or licensee, where we have true ownership economics in it.
Got it. Well, thanks so much for coming on, Andrew. Really appreciate it. And I'm still trying to wrap my head around the youth haircut thing. It would have been Dude Perfect barbershops, or salons, I guess, around the place. I mean, I don't know. Could have been fun.
I might be wrong.
We'll never know. All right. Well, thanks so much for coming on the show, Andrew. We really appreciate it. And we'll talk to you again very soon.
Thanks for having me.
Well, that does it for today's show. A reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. I want to thank Amazon Web Services, who is our presenting sponsor for this production. And I want to thank you for tuning in. We really do appreciate your viewership. I'm already excited for our next show on Monday. Have a great weekend. Bye-bye for now.